So I am back with another dividend stock analysis. Today's video comes by popular request. This is a stock that everyone has been asking about in my PPCE and YouTube community, and I also have seen it get a ton of press on the internet and on dividend blogs and just dividend investors in general. If you don't know, I invest for dividends and cash flow. I invest so that literally one day my dividend checks can pay for my living expenses. And so that's the lens by which I analyze all of my investments. And so today's video, I'm going to analyze GE. This is an iconic brand. It's a brand that most people are familiar with, especially from the light bulbs and the appliances side of things. People have heard of GE before. And because it's such an iconic brand, a lot of people take notice of GE. A lot of people think of GE when they think of blue chip companies. They think of stocks that they may want to own in their stock portfolio. Well, I can't disagree that GE has an iconic brand. It surely does. But when I actually go through my fundamental analysis, which I'm going to share with you in today's video, from a dividend growth investing standpoint, from a dividend investing standpoint, this stock really has some issues in my personal opinion. So get ready for my brand new stock analysis. Hey everyone, thank you so much for tuning in today. It's great to have you here. I have had so many comments, so much support here on my YouTube channel, and I thank all of you for that. Just in advance of the video, if you enjoy the video, if you can like, subscribe, comment, that would mean the world to me. I want to jump right in to my analysis of GE. This is a very interesting one. I actually spent a lot of time preparing for the video today, and I think even though this stock does not make the mark for my personal portfolio, and it actually fails on a number of ways, this analysis I think is going to be very helpful for folks out there. It shares a lot of the tactics that I use to analyze stocks, from a dividend investing standpoint especially. So let's start. What do I do first? I go to Yahoo Finance and I start looking at just some of the general metrics. So at a high level, it has a 3.33% dividend yield. Okay, that looks all right. That's a good starting yield for a dividend investor, meaning if I put in $1,000, I'm going to get $30 or $33.30 per year in dividend income. Not bad. So, PE, though, is NA. Okay, this is the first red flag. I look at this and there's no PE. Why? Because the earnings are negative, minus 0.719 per share. This isn't horrible at first glance because there's been a lot of one-time events recently, a lot of tax restructuring because of new tax code that has been putting a lot of PEs either really high or non-existent. And so it's not a deal breaker to begin with, but I see something like that and I'm like, okay, when I dive into GE, I better look into that. Next, I look at the market cap. Okay, it's 124 billion and change. Pretty big company. That's in my wheelhouse. Nice blue chip stock. But then let's start just looking at the price per share. Where has this thing gone over time? It's gone nowhere. Look, I don't invest for capital appreciation. I invest for dividends and cash flow. So certainly capital appreciation, meaning the stock price going up, it's not the most important thing for me. But when a stock literally goes nowhere for a very long time, I'm talking 20 years or more, that is a problem in my opinion. That is a challenge. And so I looked at the price per share and I look back just at April 1996, it was at $14.46 per share. Where is it now? March 15th, 2018, it's at $14.41. So basically, since April of 1996, this stock has gained nothing. It has gone nowhere. That is a real problem, in my opinion. Again, I don't invest for capital appreciation, but capital appreciation is a byproduct of a well-managed company. It's a byproduct of management doing its job. It's an indication that things are moving in the right direction. And quite frankly, without seeing capital appreciation, it means that the company hasn't been able to really generate any value over those years. And so these guys have had over 20 years and they haven't really created any market value there for folks other than the dividend that's been paid out, which we'll get to next has actually been cut. But anyways, also worth noting at the trough of the Great Recession, they were at $11.72. So obviously, it hasn't been a flat share price over all these years. It's had its ups and downs. But if someone is a long-term buy and hold investor like myself, I never sell. I'm buying for the cash flow. I'm buying forever, for decades. And when you just see it go nowhere, that is a big red flag for me. And by comparison, let's just look at some of the holdings that I personally own. I own these three companies: Southern Company, Procter & Gamble, and Clorox. Let's look at Southern Company. Southern Company is a regulated electric utility, and they're in natural gas now as well. Utilities in general pay out big dividends, and they don't experience a lot of capital appreciation because they're just throwing off all of their earnings as dividends. They're not really reinvesting too much in the company because they have a stable business. Even this regulated electric utility, over this same time period from April 96 through now, it's gone from $13.44 per share to $44.05 per share. So it's done quite well. At a minimum, I would expect something somewhat similar from a world-class blue chip name. If it cannot even beat a utility in terms of capital appreciation, again, the capital appreciation I'm not trying to sell, but it's an indication of other things. It's an indication of other problems. If it cannot even keep up with Southern Company, that is a challenge and that is a red flag. Procter & Gamble over the same time period went from $22.66. It went up to $78.82. That would be expected, world-class blue chip iconic brand. Clorox went from $21.28 to $126.86. So certainly, I wouldn't expect GE to keep up with Procter & Gamble and Clorox. These are consumer, non-cyclical companies. These are iconic brands. They have great portfolios. They're goods that everyone needs every day for their life. By contrast, GE is generally considered, in my opinion, more of a B2B business. The types of functions that they're in, like they're in transportation, they're in engines, they're in heavy equipment, medical equipment, renewable energy, oil and gas related equipment. They are more of a B2B company, an industrial, if you will. So for me, I would have expected the capital appreciation to be between the utility and the consumer non-cyclicals. So I'd expect it to be somewhere between Southern and Clorox, somewhere in that range. But to be nowhere, to go nowhere, right off the bat, I could probably just walk from this opportunity at this point. But that said, I wanted to dig further and really get to the bottom of what's going on with GE. So let's get to the next thing. So that's just the first thing I did is all of that's just literally on Yahoo Finance, just some quick checks. One more thing actually I pulled on Yahoo Finance, just so you're aware of, is listed down here. Debt, $134 billion in debt. We know interest rates are going up. We know they're going to have to refinance this debt. That could be challenging for them, especially when their market cap is only $124 billion. That being said, I wouldn't get too overly concerned with the debt because in essence, they are also a financial institution. GE owns what's called GE Capital. We're going to talk more about this later, but because they own GE Capital is a bank, and when you're analyzing a bank and a bank is mixed in with other business units, it can throw off the debt and it can make it look a little worse than it is. That being said, just worth noting that they carry a lot of debt. So I want to next go just into the dividend history. Look, I invest for dividends, and I look for companies that grow dividends over time. My favorite companies grow dividends on average between 5 and 7% per year. I like dividend companies that grow around 7% per year. At a minimum, they need to keep the dividends steady. Maybe there's a rough year. Maybe there's a rough 5-year period keeping the dividends steady. But certainly I look for companies that grow the dividend. With GE, I looked at 2013 through 2018. They were growing it. 19 cents, 22 cents, 23, 23, 24. So 15, 16, there wasn't a lot of growth. And by the way, this is the quarterly dividend. So for the annual dividend, you would just multiply it by 4 because they pay 4 times per year. So this is a quarterly dividend. 2018, bam, they cut this thing to 12 cents. They cut the dividend in half. For me, that is a very big red flag as a dividend investor. Once a company, look, I rarely, if ever, sell, and I don't own GE. The one case where I would consider selling is with a dividend cut. And I actually did this. I shared a video, I'm going to link to it in the description below, with my greatest mistakes in the stock market. One of my mistakes was buying BHP Billiton. This is a company that cut its dividend, and I sold it. I rarely, if ever, sell a company, but if a company cuts its dividend, that is just not, that's completely counter to my entire strategy. My entire strategy is to live off of dividends, to pay bills. And even before I can fully live off of dividends, even in the short run, let's say right now I wanted to start paying some bills with dividends. Let's say like my phone bill, my gas bill, my electricity bill, groceries. I can start doing that even right now. And so the fact, but I don't, by the way, because I reinvest my dividends because I want to compound them even further so that further out, when I really need the income, I've got even more. But the fact of the matter is if this company cuts its dividend, that's cutting my income. That's cutting my source of income right there. That is disrespectful of the shareholders. And look, maybe they had to do it because things are so bad, but I don't want to own a company where things are so bad, where they have to cut the dividend. It just is completely counter to my way of investing. Now, let's take this a contrarian approach. Maybe you're a different type of investor. Maybe you want to buy low, sell high. That's not me. This thing is at a real low. It's gone nowhere in 20 years. Maybe they're restructuring now. They're trying to figure things out. They're trying to fix things. Maybe they fix things. Maybe it goes up. Maybe there's an opportunity now to buy low, sell high. For me, I don't really care about that. For me, I'm looking more at the long term, and I just know if they cut the dividend, if they're having all this trouble, who knows if they repeat that again. For me, it's a one strike and you're out on a dividend cut. Maybe there's a rare exception, so I never want to say never, but generally speaking, it's one strike and you're out when I'm looking at dividend cuts. So anyways, let's now look at revenue. The revenue for this company has gone nowhere. In fact, it's gone down. And so in 2017, it was 122 billion. It's been pretty flat for all of these years, 2016, 15, 14. It's actually up versus 2013, which was at 113 billion. But if you go back to some of the prior years, like a circa 2008, revenue was way higher. It was $181 billion. So in the last few years, revenue is flat. Over the longer term, revenue is down. This is a company that never recovered from the Great Recession. And so that is a red flag. And look, I own companies in my portfolio that have had revenue challenges. One that I've been analyzing here, I'll link in the description below to some of those videos, is Kimberly-Clark. I'm actively buying Kimberly-Clark. Revenue there hasn't been really strong, but their earnings have been strong. And their earnings have been strong because they've been able to manage their costs during this sluggish period of growth, and I expect an uptick in revenue in future years. Challenge with GE is, we'll get into it later, but the profitability is challenged as well. And one thing that I found when you analyze a stock like this from a dividend standpoint, it's not ever going to be perfect. There will always be one or two things that are off. And so like I said, with Kimberly-Clark, what was off was the revenue, the top line. That was the biggest challenge. There's probably a few other challenges as well, but that was the big one that stands out. With this company, with GE, I'm unfortunately seeing challenges everywhere I look, and so I can't get past it. When there's a company I like and I want to buy and there's one thing wrong, usually that's why there is a buying opportunity. And look, I like to buy when a stock has gone down, like with Kimberly-Clark. It's down. I like to buy when it's down, and I know it's down for a reason because revenue is sluggish. But they've got other things going for them. Unfortunately, at GE, the stock is down, and it's not only revenue, but it's the dividend. It's the price per share has been nowhere in 20 years. It's a bunch of other stuff that we're going to get to in a minute. It's the fact they're having troubles with this business. They're having troubles with their GE credit. We'll see more in a minute, but there's basically troubles everywhere I look. So what I want to look next is profitability. I think this is important. So like I said, even though revenue hasn't gone anywhere, even though it's gone down, sometimes companies can do well with a shrinking amount of revenue. In fact, maybe they've sold off business units. Maybe they're trying to pare down and focus. Maybe they're able to really focus, lower revenue, but increase earnings per share because they can cut out a lot of waste. You actually see this with some other stocks out there. But anyways, profitability. This company's profitability is going down. And so their operating margin, for example, I like operating margin. I like looking at operating margin because it's pre-taxes. And right now we know with tax reform, there's a lot of wacky stuff going on. But it includes cost of goods sold. It includes sales and marketing. And so it includes all the important stuff. It does not include the taxes. And so again, this is going to be a margin that I think is quite important. And it's already, honestly, it's starting low and it's going lower. So in 2015, it was 11.7%. 2016, 11.4. And 2017, this thing dipped to 5.7% operating margin. That is horrible. And so companies that I own, I typically shoot for higher operating margins than this. Even to begin with, 11.7 is kind of low, and certainly it differs by industry, but for an industrial, a cyclical type of industrial like GE, I would look for at least like maybe 15%, probably even higher than that. But for it to start this low and then get worse, that is concerning. What I also did here, you might recall, earnings per share is negative. I didn't really, like I said at the beginning, PE, no PE. I didn't really take a lot of weight in that because there could be weird stuff just going on, like I said, with accounting, tax reform. And in a case where earnings per share looks weird, sometimes it's just good to look at cash flow, because cash flow is literally the cash coming through the doors. And look at cash flow is down. 7.7 billion, 7.1 billion, 5.6 billion. The cash flow is shrinking. So literally, this company has challenges with the revenue, with the margins, and with the cash flow. This, in my opinion, and they've got a lot of debt, but again, I wouldn't take too much weight because they are a bank. But boy, those are a lot of challenges with GE right now. And so I'm just seeing one thing after the other. Okay, let's go now to the last thing here, at least on here. GE Capital. I would say this is the thing. GE Capital is GE's bank. This is probably the thing that concerns me the most. What is GE Capital? Let's say I'm an airplane company and I want to go and buy some jet engines from GE. Let's say I don't have enough money to buy those jet engines, or let's say I just don't want to put out the money, pay for cash. I don't need to because interest rates are low. Hey, GE Capital, can you finance my transaction? Can you allow me to buy your jet engine and give me a really good interest rate and I can finance it over time? That's what GE Capital does. I'm sure they lend in other ways as well. The fact of the matter is GE Capital is doing some horrible, horrible things in terms of performance. In 2015, they lost $8 billion. In 2016, 1.3. 2017, 6.8. Look, the Great Recession has been over for a while now. 2017, we're a pretty good economy here. To lose $6.8 billion, that's very concerning. And what it tells me is GE is using this GE Capital to fund people, to basically bolster their other lines of businesses, to fund businesses to help them buy stuff from GE. They're extending very favorable terms, and what's happening is a lot of these loans are going bad. And when the loans go bad, who loses? GE. This is a lot different than a bank, like a traditional bank. A traditional bank will lend money, but it will be secured by real estate. And we all know real estate carries a lot of value. And so there's a lot less risk in that, because even if the borrower cannot pay their loan, okay, the bank is going to foreclose. And the bank is going to take that real estate asset and it's going to be worth a lot of money. And for all we know, it could be worth even more than when they lent the money for the borrower to buy the real estate. Let's take a different approach here now with GE. They're selling a jet engine. The person who bought the jet engine can't pay for it. They can't take that back, or even if they do, they're not going to sell a used jet engine. So they are losing a ton of money. There's no real asset behind the lending. And so this is risky business. I know there's other companies that do this as well. It seems like GE is kind of the poster child for how to do it wrong. And so just something here that is really a red flag for me, that I just don't like. The fact that GE Capital, one, it exists. Two, it's losing so much money. And three, I think it's just a greater indication of the overall business. I think what GE Capital, they're not, these people at GE are smart. I mean, I guess what I'm saying, they're logical. They probably knew they were making some aggressive loans, but the fact of the matter is they did it on purpose. Why did they do it on purpose? They probably realized that their business is sluggish. And they're like, look, it's so sluggish, and so we have to be aggressive on these loans to get the business to grow. At least that's my hypothesis. I don't know. That's not confirmed with data, but just based on what I've seen here, that's a logical scenario that could be playing out here. And so anyways, I think the fact that they are losing money here when they probably could have avoided that tells you something. It tells you, hey, somewhat consciously or maybe even subconsciously, they're losing money on GE Capital, it probably tells you that the people that work at GE feel like they had to do that because the rest of the business is doing so bad. And so anyways, that's something that really concerns me. So before we close out today, I also just jotted down a few notes in my notebook that I want to cover. They are in a bunch of businesses. Some of them are doing well, some of them are not. And so just as a general overview for people, this is a conglomerate. This is an industrial company, a conglomerate, and they're in power, renewable energy, oil and gas, aviation, healthcare, transportation, lighting, and GE Capital. In general, look, I own some companies like that. I would say, like, look, Procter & Gamble is in a bunch of businesses, but they're all really related to consumers, and they're not so dissimilar. I generally don't like big industrial conglomerates because it's really hard to analyze them. There's so many different businesses, and it's easy to mask problems too when there's problems with one business and not another. And so anyways, that's just something worth noting, that there kind of been too many businesses in my opinion. And maybe there will be luck going forward that with the restructuring, with the new management, they will sell off some of their businesses, they will improve. But again, look, I'm not a buy low, sell high kind of person. And at this point, the picture is so bad, and the dividend cut alone is a deal breaker for me that this just doesn't make sense for my personal strategy. So one thing worth noting that I think is really important here is I started looking at their annual report. And in their annual report, I started looking at the different business lines. Which business lines are doing well, which ones are doing bad. I wish they did this on a consolidated level. I couldn't find it, so I just saw it on business line by business line. But one thing that was cool is I looked at revenues domestically in the US versus international. And I started seeing a trend. They do a lot of business internationally. In fact, it looked like in a lot of their business units, it was actually more than half of the revenue is coming internationally versus domestic US. I thought that was cool. And so a lot of people here on my YouTube channel ask, Ian, do you invest internationally? How do you invest internationally? I do have some pure play international companies. I'm going to do a future video on that. But also, look, I'm not a holder of GE, and I never will be. But just by owning a US-based company as well, oftentimes there's a way to get that international exposure. And certainly, I would say that's if there's one silver lining to all of this, one of them is that they have that international exposure. So I thought that was pretty cool. So a few lessons here. Takeaways. Obviously, everyone loves this stock right now. I don't know why. I think it's just because it's at a 20-year low. Maybe there's also that hope that it will rebound. It probably will. But again, it's not for me, not for this dividend investor. But what did I learn by doing this analysis? I speak a lot on my YouTube channel about brand, iconic brands, and how I like to invest in brands. I invest like Peter Lynch. He's a famous mutual fund manager from Fidelity, from the Magellan Fund way back in the day. He's written a bunch of books. I like his books. I invest like him. I like iconic brands, but I only like them when all the fundamentals back them up. So yeah, GE's got the iconic brand for it here, but the fundamentals don't support it. And so that's an important takeaway here. I think an important takeaway as well is diversification. I own 36 stocks. I'm sure of that 36 stocks in my dividend portfolio, there's going to be some losers. And there have been losers in the past. I've had to prune the portfolio. But even what I have now, I feel great about all of them. I'm sure a few of them will pop up to be losers. As one's dividend portfolio gets bigger, I think it's really important to identify a diversification strategy and to realize that no one is perfect. And maybe someone has been holding GE a long time and it just didn't materialize how they thought it would be. Because look, I have all this data now. It's easy to look at it now, but 10 years ago, I looked at the data. Maybe I would have looked at the data they had at that time, and maybe I would have made a different conclusion. Maybe I would have made a mistake and bought it. Who knows? Maybe I'm doing that with other companies right now. The key is diversification. I think that's really important for dividend investors, especially when one is relying on income. One is trying to live, or maybe not fully live, but even partially live, pay bills from income from dividends. One wants to diversify because one doesn't want to put their income source at jeopardy. What else did I learn from this analysis? I learned that it's important to do your own analysis and to not listen to the community. Look, it's okay to listen to the community, but what I'm saying is don't base your decisions. I shouldn't base my decisions. No one should on what other people say. And just because there's a lot of fanfare, there's a lot of love for this company right now, amongst value investors, people think it's a deep discount. I need to make up my own mind, and my own mind is that it's not for me. That said, look, if someone else looks at the same numbers, maybe I'm wrong. They really like it. It works for them. Look, I wish them well. And look, if you're watching and you own GE, I'm not trying to put you down as an investor or put down GE as a company. I wish you all the success in the world. The purpose of this video really is to start a discussion, to start a debate, and to realize that different people will have different opinions in dividend investing, but all of us could win. All of us can do really well with even different strategies. But again, I totally wish you well if you do own GE. But for me, I can't listen to what other people are doing out there. I have to formulate my own opinion, and that's an important takeaway. Something else, things change. This is something we don't discuss here as much on my channel, but I think it's an important note. One of the biggest challenges with dividend investing for it to work is one's in it forever. One's in it for decades, for a long time. Things can change. I try to own companies that won't change. I think something like a Southern, something like a Procter & Gamble, Kimberly-Clark, Clorox, they don't change as much. Is the technology behind a diaper going to be that different 30 years from now than it is now? Probably not. Is the technology behind delivering electricity to one's house going to change that much? Probably not. Are things changing with GE, with jet engines, with medical devices, with the types of things that they're in? Yes. In companies that have a lot of change, it's important for them to keep up. And so, look, I have companies in my portfolio that are on the cutting edge of technology, and they always have to reinvent themselves. And I like those companies, but when you invest in those companies, GE would fall into that bucket. One has to be very cautious that they are good at keeping up with the change. And so that's part of things change. The other part of things change is just things change. Look, this world is different. Things change. Sometimes one has to adapt to their portfolio. Look, like I said before, if one has a diversified strategy, one makes a mistake. Sometimes one has to look at their portfolio and say, like, look, I made a mistake. And sometimes one has to sell and realize the loss or realize the mistake and move on. And I had to do that with BHP Billiton. It was in that video I'm linking to below on my biggest mistakes. That said, I'm not advocating selling. Certainly this could turn around. Maybe it's the perfect low point to buy. I just don't know. But again, things change. And that's really important just as a dividend investor to think about anything one is doing. Things are going to change. What else? This is a key takeaway. I already mentioned it, but I want to mention it again. When I analyze a stock, if one or two things are bad, fine. I understand the stocks go down, and I typically only buy them when they are down. I realize things don't go down for no reason. Usually there's something wrong. We talked about that with Kimberly-Clark. But if there's like all the factors are bad, everything is bad. Look, even when I was reading their annual report, the CEO of the company even realized and mentioned to everyone, hey, things aren't that good. We need to turn this around. And when you go through the report, it was almost an explanation of why things are so bad. If everything is bad, that's concerning to me. When one thing is bad, two things are bad, that's not concerning to me. So very important takeaway. I think one last takeaway and lesson is just conglomerates. Conglomerates are really tricky. They're just really hard to manage, to measure, to analyze a conglomerate. So there you go, everyone. This is my analysis of GE. Thanks for hanging in there. If you made it all this way in the video, I really appreciate it. That is awesome. Thank you for sticking in. And thank you for that question. I know a bunch of you asked about it, and I hope that this doesn't come across as bad news. I do realize that people watching, maybe not all of you, but some of you own GE. I'm not trying to put you down as an investor or your investment. Maybe I'm wrong. Like I said, everyone has different ways of looking at it. So I invite you in the comments below to share your opinion, to share, hey, Ian, here's why I think you might be wrong, or here's something you might have overlooked. Let's bring that debate. That's the purpose of this channel too, is to vet ideas, to bring all of our opinions, because I think our collective intelligence is going to be way bigger than just my analysis on these videos for sure. So certainly a fun aspect of the community here. And I just want to thank you guys for that question. And if you are in GE, I wish you the best and I wish you well. And I hope it is a low point for the company and that they turn it around here for the GE investors. And so before I leave today, just a disclaimer. I mentioned a bunch of stocks today that I own. I want to repeat them right now. I own Southern Company, Procter & Gamble, Clorox, and also Kimberly-Clark. Those are ticker symbols SO, PG, CLX, and KMB. I am long on all four of those stocks. Also, in terms of a disclaimer, I am not a licensed investment advisor. Today's video is not investment advice. This video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. I want to thank you again. If you enjoyed the video, please give me a thumbs up, a subscription, a like, a comment, all of that. It means the world to me. I'm so grateful for the growing community here. If you have ideas for my next video, please send them over, and I will see you in the next dividend investing video.